And we're live. G'day, I'm Scotty North, and this is Zenium Live, where we talk all things money, finance, and property. And today is Thursday, lunchtime in Queensland and New South Wales, Victoria time. So make sure you grab a sausage roll and a drink and settle in for some great information and content from today's guest. And that is PJ Patterson from Keystone Financial. PJ, how you going, mate?
I'm good. I'm good. I seem to be a little out of focus at the moment. I'm not sure what's happened there, but anyway, we'll try to get the camera to focus in on me here. How are you today?
Mate, if it's any consolation, the backdrop's in perfect focus. And
Of course it is.
You were working before we hit the go button, so that's just the way that technology happens, mate. It's the way it goes.
Sometimes decides to be a bit funny. Yes, indeed. So we'll persevere, mate. We'll persevere.
Well, that's okay, mate. I look as good as usual, so that's probably the main thing, and that's what everyone tunes in for anyway. So let's dig into what the topic of the day is, which we'd call it reading the tea leaves. And now you and I had a discussion offline as to what we're going to do this show about, because as we know, it's sort of a topic show, right? It's not a market update. We try and teach people about one thing every month. And
Yep.
this one was, we really nutted our heads together and went, there's so much information out there and it's like conflicting, property's going down, property's going up. It's a good time to be in shares. It's a bad time to be in shares. And it's like just all over the place. Oh, the economy's going well. Oh, it's going to fall off a cliff, right? So what I really wanted to get into was there's some strategies that you use and you use with your clients as to, how to decipher that information. So give us some easy tools for the people watching and listening as to what they can do and how can they cut through this media hype and the emotion of the markets.
Yep. Good questions all there. Well, first of all, the advice I would give to everybody is to stop watching the news, and certainly stop watching the financial news, because most of the people on those channels don't know what they're talking about. They're just trying to spruik the market or whatever and just fill airtime. So it's very difficult for any professional level investor to take any of those folks seriously. And I'm talking about the CNBCs, the MSNBC, the Sky Business, and all of that stuff. They're just there to fill airtime and to talk about, particulars, I suppose. One of the things that I do in my business is, first and foremost, we start with the global macro environment. So we look at the entire globe and what's going on in pretty much every country in the world, and start with that to see what the prevailing trends are, to see what the prevailing conditions are, and then we drill more deeply into country specific. And from there, of course, we're able to, from all of that, determine what areas of the market to invest in. Now, the way we do that is...
Just hang on. So just let me get this straight, because I'm taking notes here because I find this really interesting. So you're telling me the first easy point for the people watching to do is you just got to look at every market in the world?
Sort of. I'm not saying look at every market in the world. I'm saying you have to be, let me rephrase that, right? You need to be able as an investor to go anywhere and invest in anything. So that includes things like stocks or bonds or commodities or gold or currencies. And so it means that you need to have a view on what's going on in the entire world, because of course Australia, whilst we are the largest island in the world, we are not isolated economically. We rely on a lot of things going on in other parts of the world, and we interact economically with a lot of other countries. And if things are going well in places like China and Korea and India and the US and Europe, then things are probably going to be going well in Australia. Commensurately, if things aren't going so well in those other countries, then things are probably not going to go so well for Australia. So when I say look at the world or look at the global macro environment, what we're really looking for there are some key trends and some key things that are affecting economies. And I've talked about this before, and I'll mention them again. It's basically a 3-factor model. We're looking at what is the growth or GDP doing in countries around the world, in key countries like China and the US and the European, some of the key economies in Europe. What's happening with inflation in those countries, and what's happening with interest rates. And if you can get the direction of those 3 things broadly correct, it means something important for how you should be investing. And it'll give you, as you can see from the backdrop there, it'll give you a bit of insight into what may be coming down the pike later that year or even later that quarter. And we'll delve into that a bit more deeply today. But I want to start with, and I think it's key, is you want to pull right the way back, all the way back, and just look at everything and see what's going on. What are the broad global economic themes?
Okay, all right. So, and I was having a bit of a joke before. I mean, obviously, you're not going to look at every country in detail because that's not what we're trying to set out to do. We're trying to make it easier. So, how do you then go to the next step? So we've sort of got an idea of the picture of globally. So then what's next?
Sure. So I think, one of the things that I do and many investors do is they key in on a couple of very important markets that have major influence into what's going on in the global economic cycle. The US, obviously, China, and broadly speaking, Europe. So those three economies put together are, the bulk of global GDP. So if the US is struggling, then chances are other parts of the world are going to be struggling. If China is struggling, as I mentioned a moment ago, again, Australia will probably be struggling as well. And if those large economies are doing well, and we'll talk about that in a moment, from a growth, inflation, and interest rate perspective, then it's a good sign on the road to say, Australia is probably going to benefit. And as such, you then look at or extrapolate out how should you invest specifically in your location that you're in. So in Australia, in our case, how should you invest in Australia? And again, we'll talk about that in just a moment. But why don't we just start putting some real meat on the bones of this discussion and talk about real things. So I mentioned growth, inflation, and interest rates. So where are we at with those things at the moment? So we know that around the globe, central banks have been cutting interest rates over the last, they've really been cutting them over the last 10 years or so, but they've really gotten down now to almost zero, if not zero, and in some cases negative interest rates. We won't really go into that today, but Australia just recently on Melbourne Cup Day, in fact, cut another 15 basis points off the cash rate. So it's now 0.1% or 10 basis points is the cash rate in Australia. It really can't go any lower. And so we really have, for all intents and purposes in Australia, a zero interest rate policy. So the Reserve Bank here has done everything they can. They've been cutting interest rates. Interest rates have been falling. That's good, or will be good for the economy. So that's a plus in the column for knots and crosses. That is, a plus sign, or pluses and minuses, I should say. The second thing is we know that governments around the world have also been stimulating heavily. So you look at fiscal policies in Australia and the US and China and a lot of these other locations, they're all stimulating heavily. So they're spending on infrastructure, they're giving money to people, they're sending them checks, they're trying to get people spending again because global consumption or you and I spending money drives about 65% of the global economy. So what we do, what you and I do in terms of our spending habits, ultimately drives gross domestic product, or what a nation produces. And then I suppose the final thing is that we haven't really seen inflation yet really starting to creep in, but they're trying to drive that. So I talked about that three-factor model: growth, inflation, and interest rates. So all three of those things can be measured and they can be mapped. And the rate of change of those things can also be measured and mapped. So what you actually want to find yourself in, and this is again where we've talked about the quad model that I use, is you want to find yourself in quad 1 or 2. And what that means is that growth is accelerating, so that's good. GDP is growing. It means that interest rates are probably rising a little bit or are flat. So flat to slightly rising, which isn't too bad. And inflation is either nominal, so it's not really doing much, or it's rising slightly. So quad 2 is actually the quad where you really see a lot of reflation occurring. And I'm bringing this up because Australia, and the globe for that matter, is in a reflation phase. So we're going to see over the next 2 quarters, so the first quarter and the second quarter of 2021, we're going to see pretty much every country around the world in a quad 2 environment. Now, I'm bringing this up because it's going to be definitely in Australia, and it's going to drive a lot of the stock market growth. You're going to see consumers out spending again. And again, this will be off the back of low interest rates, government stimulus, and of course, us getting over the sort of COVID lockdowns and all that stuff. So we're going to see people going back to hopefully some sense of normality in their lives. And we're just going to see the world emerge from that really dark period that we had from, say, March, April of this year through to probably about August, even September of this year, when everything looked very dire indeed. We're now at the other end of that. We're now at the rain has passed, the sun has come back out, and we're really going to start to see the growth in the economies and returning to that sort of a pattern and pathway, at least for a couple of quarters. So that's all very good news. And so the tea leaves that, the topic of our thing today was reading the tea leaves. Those are the tea leaves that you should read: the growth, inflation, and interest rate, and the direction of those things. And also, I suppose, the intensity of them. And they're all moving in the right direction, I guess, is ultimately my point.
Okay, so that's a pretty good background of what the data is that the overall data that should be looked at. But how does someone get good data on those 3 points of inflation, interest rates, and growth? I mean, obviously, interest rates is easy if you're just looking at what is the interest rate. But interest rates is perhaps harder if you're looking at where the trending future of interest rates are going. That's probably a bit, crystal balling. But inflation and growth, I mean, how is there just like one document someone can get and says, okay, this is where these three things are at, or is this like we've got to look at every newspaper around the place, or how do you make it easy for someone?
Well, it isn't easy. Unfortunately, it does require a lot of work, and I get a lot of this data provided to me from various institutional services that I subscribe to, and they aggregate that data from various reports that central banks put out. I mean, Bloomberg, I'm sure many of the people watching this or would watch this have heard of Bloomberg. He sort of invented the whole Bloomberg terminal and the aggregation of data. So a lot of the data, which is published by governments, by various government institutions, and even some private sector companies that track a lot of this data, has to be aggregated somewhere. So that gets aggregated, and I actually get that. Now, there is one website in Australia that I have used previously. It used to provide a lot of free data, but I think they figured out that they should probably be charging for it. And it's called Trading Economics, and it's I think it's tradingeconomics.com.au perhaps. But anyway, they provide a lot of this data. But if you just go to the RBA website as an example, you can get data on the current GDP of Australia. You can get data on interest rates and so forth. So the reality is, of course, you probably knew I was going to say this, is you should deal with a professional like me that's actually doing a lot of that work for you and can just tell you what's going on. Because for the average human being who has a normal job and is looking after their family and trying to enjoy themselves on the weekend, just isn't going to spend the time doing a lot of that work, because either they don't know where to look or they don't really have the time to do it. So you really need to either subscribe to some service that provides it or deal with a professional that is looking at those sort of global macro things on your behalf.
And the other thing too is that it's one thing to get data, but how do you interpret it? I mean, it's you can get one data set and have three different people, and you get three different opinions about what that data set's actually saying.
Well, yes and no. So I don't necessarily think that's the case, because what we're actually looking for is rate of change of data. So, a lot of data, it depends on the type of data that it is. I mean, GDP data would be pretty solid. So you're not going to get a debate on, is the GDP figure correct? I mean, it does go through revisions. But what you want to look at is the change of that metric from the previous reporting period. So, for example, if you're seeing, as we will see, Australian GDP continue to accelerate through the third quarter of 2021, that will not be debatable. It will either happen or it won't happen, right? Numbers typically don't lie. You can't really interpret numbers as such that are hard numbers like that. So what we're looking at is we're wanting to see, is that GDP growth rate accelerating, staying the same, or decelerating? And that is one of the tricks of reading the tea leaves, is you could have for argument's sake, a GDP number that continues to grow, but it could be decelerating in terms of its growth from the previous reporting period. So whilst you might say, oh, look, GDP again this quarter is up, it may be up less than what it was in the prior reporting period, so the third quarter of 2020, year over year, or it could even be slightly down from the previous quarter in that financial year. So in other words, it's the nuance of the data that, again, won't be debatable, but those are the things that need to be observed. Those are the particulars, I guess, that you need to, observe, and then interpret those and extrapolate those out into actually meaning something. So that's what a global macro investor is ultimately trying to do.
Now, is this the website you're talking about? This is Trading Economics.
That's the one. Yep, Trading Economics. Yep, precisely. Yep. There's a ton of data on there, and they aggregate a lot of data as well. Again, I think, unfortunately, you have to pay for a lot of the stuff you get off that website now, but that would be a source if you did want to invest in, really understanding economics and looking at that. That's a wonderful website to go to and get data. And it gives you the trends and other things as well, and it does some of the analysis for you, but yeah.
Yeah, no, that's good. Yeah, I mean, I think when I said data before, I wasn't necessarily saying that they wouldn't agree on the data. I think it's more that they'd agree what to do after reading the data. That's where the opinions that I see, especially in the property market, they see trends and they go, oh, well, that means we should do this, and someone else, oh, that means we should do that. Mm-hmm. Whereas in reality, it's just opinions, right? So all this data is just facts and figures and numbers. So what's the easiest way? I'm trying to make this easy, right? What's the easiest way for someone to engage with this information? Let's put it that way. So obviously they can look up that website, but that's not going to mean a whole lot to a bunch of people watching this.
No, it isn't.
This.
Yeah. Again,
so is there an email? Do you do a like a monthly take on this data? Like how do people get access to bite-sized and edible outcomes?
Yeah, very difficult. I've got to say there's really sort of several schools of thought out there in the investment community. A lot of what you get on the mainstream media and through newsletters and all these other people that are in my industry is they will talk about their stock pick. It's a lot of narratives. They say, well, I like this stock because it's, they're doing great things and the CEO is going to change the world and all of this nonsense. As opposed to raw and hard data, which is, well, what are the company's earnings? Are they growing or are they shrinking? Is their margins, are their margins growing or shrinking? How will a growing economy impact their bottom line? Things of this nature. The Tesla comes to mind as a great example of this, where a lot of people bought into Tesla because they like the story of the stock. So for a long time, of course, it's traded on that. It's now one of the largest car manufacturers in the world, even though it produces I think less than a tenth of the vehicles that something like a company like General Motors does, and yet their market cap is like 4 or 5 times that of General Motors. It's just ridiculous, right? And that's because people are buying into a story as opposed to really looking at, is this a properly investable sort of company? But back to your original question, though, it isn't easy, and there isn't an easy place to go and get it. Now, I provide to my clients a weekly market update, and I take a lot of the data that I get on a daily basis because I'm up at the moment because the U.S. Because of daylight savings, the U.S. markets are still open when I wake up and don't close until 8 a.m. Sydney time. So I get up about 5:30 every morning now, usually 5 a.m. during the winter, to watch the last couple of hours of trading and to do any research and so forth that I need to that morning. But it's a really hard job. Like being a professional money manager, which is effectively what I am, is an exceptionally hard job. So it isn't easy for the average punter, and that's why the average punter typically loses money on things like stock picks. They get some idea from some newsletter or some guy at the pub or whatever, and they invest some money and they don't know how to, for example, size positions. They don't know whether it's even the right time in the market cycle to invest in a particular type of business. And so again, that's where a lot of people shouldn't actually do any of the things that I'm talking about. They should entrust that to a professional who has their bum bolted in the chair and is on the switch, I don't want to say 24/7, but certainly, 5 days a week, really watching this stuff.
And how do they pick that person? I mean, obviously, you're one. You're on the show. That's why we get you
Mm.
on the show. But if someone was in WA and wanted to actually go and eyeball a person, if they were that way inclined, right? What are the things that they should be asking to find out if that person has a real clue or not?
Yeah, it's a very good question. And, you're going to get any number of answers from professionals that you might ask this question of. But I think it boils down to this one thing. As an advisor, and if I was a client potentially sussing out or looking at potential advisors, I would ask that advisor, do they have a go anywhere strategy? And what I mean by that is, in this day and age, most of the time when you go to a financial planning firm or an advisor, they're going to use this phrase that I'm about to utter, which is, it's not about market timing, it's about time in the market. If you just buy and hold over the long term, you'll be fine. And
It's the get out clause. That's the get out clause. It's like
It is,
I've screwed up. Look, give it 50 years and you'll recover.
yeah. It's sort of a get out clause, Scotty, but it's more than that. It's saying I'm too lazy to do the work and to understand all these markets and to do the research and spend the time to say, okay, right now in this market cycle, you need to be out of equities and you need to be invested in bonds, or you need to be heavily exposed to equities and energy and other things that are going to perform well in this cycle. That advisor that I just described, who says it's time in the market and we're just buy and hold, doesn't have a clue. And because they don't have a clue, they have to keep you invested through thick and thin. Whereas an advisor like me is saying, I can anticipate changes in the market because I'm watching the data. And the data is the tea leaf right behind me, right there. The data is that. And by following the data, it doesn't mean I'm going to be perfect every single time. And I'll probably be early, if anything. But as an example, when the latest crisis occurred, so we had that big sell-off in sort of March and April because of COVID shutting everything down. As it happened, the economies of the world were already slowing, and the data was saying this, right? It wasn't a guess, it wasn't an interpretation, it was hardcore facts. Earnings were slowing. Economic growth was slowing in most parts of the world. And that was a sign that it was time to get out of equities. You weren't going to see a lot of growth coming from stocks, and to reposition portfolios for a more defensive posture. Now, as it happens, I got super lucky because I had already positioned clients that way. And so when the crash came, my clients actually had zero loss because they were already out of all of the growth and other things that were going to be impacted by slowing economy. So, I mean, you could say I got lucky, but I was there anyway. The severity of the downturn was exacerbated by COVID, there's no doubt, but we were still going to have a downturn. Whether it was going to end up being a recession or not, who knows? We'll never know that, of course, but that just goes to show you that I'm the type of advisor that says, I can anticipate that there's going to be changes in the global economic environment and in the cycle. And I want to be able to reposition my clients' portfolios to not lose capital when the change comes. And this is a very important point about managing money. Is my job as an advisor is to protect your capital and to ensure that we don't lose money. Not losing money, believe you me, is just as good as making money. Because if you think about all those poor buggers in March and April of this year who watched their accounts, their superannuation, probably their personal stock trading accounts go down 20, 30, 35%, would have been panicking. They would have been shitting themselves going, oh my God, it's the GFC all over again. Yeah. I've just lost 30% of my money. Am I going to lose another 50%? Should I just sell now or whatever? As opposed to my clients who, and I did get phone calls, but my clients who I said to them, look, you're already out of the market. Your account hasn't gone down at all. In fact, I'm ready to deploy the capital when I see the opportunity arise. And we've started doing that as of about a month ago. anticipating what I was describing earlier, which is a quad 2 global environment where the markets and a lot of things are going to be absolutely ripping to the upside in the next couple of quarters.
So I'm just doing some sums here, right? Because you said that not losing money is almost as good as, is better than, or as good as, making money, whatever. So let's just say in that March quarter, someone had $1 million in the market, right? And that went down to 700,000. They've lost 30%. But on my calculations here, they've got to earn almost 43% to get back up to the $1 million again, right? So
that is correct.
In essence, if you're in the market and $1 million, you go down to 700,000, or you're in the market $1 million and you don't lose anything because you've been repositioned through this sort of strategy, you've essentially got around the need for a 43% gain to get back to zero even Stevens, right? That's the way I'm doing the calculations.
Yep.
So in my head, it's much more favorable because that's a pretty hard gain to achieve, right? It's much more favorable to not have the loss than it is to try and get the 43% gain again.
Yes, correct. 100% right. 100% right. And this is a concept that many investors simply do not grasp. And that is, if you take, for example, positions go against me all the time. And a lot of the time as an investor, I have to make the decision to take a small loss before it becomes a really big loss. And for exactly the same reason that you just articulated, which is if I have a 5% loss in a position, well, I need a 5% gain to get back to even. And a 5% gain isn't necessarily a hard thing to do versus something like, taking a 30 or 35% loss and then having to have a 43 or 50% gain, which is a hell of a lot harder with less capital, mind you, to do. So it's a very important lesson in investing that you should take a lot of small losses and avoid the big loss so that you can preserve capital and then be in a position to compound returns over the long term. One of the other keys to what I've just said there is because people will, the cynics out there be going, oh, well, that, sounds easy, right? You make it sound so easy, PJ, but how do you do it? Well, again, we go all the way back to the global macroeconomic environment stuff that I just mentioned, but also knowing what to buy and how much of it you should buy or how to size positions. And this is something we can talk about maybe in another show because it's getting more down to the nitty gritty of investing, but how to size positions so that if something does start to move against you, it's not 50% of your capital. So many investors, I've seen it time and again, they would say, oh, I love this stock, it's going to go to the moon, I'm going to put 50% of my account balance into one position, which is just ludicrous. So many people do that thinking they're going to swing for the fence, they're going to try to get a 6 or hit a home run, and invariably it doesn't work out and they end up losing a significant amount of their capital because they were greedy or trying to be.
That's the hero shot, mate. They're going for the hero shot. And look, there's a big difference between investing and speculating, right? I mean, there's some people call it the same thing, but there's calculating investing, and then there's the I'll bet on black.
Yeah. Well, even in that sentence that you just said there, investing and speculating, I think a good investor is an investor, again, who has a go anywhere strategy and who is willing to change the composition of their portfolio to correctly suit this part of the cycle that you're in. Now, that's a lot of words I just said there. So let me just boil that down for you. Leading into the beginning of 2020, right? So the first couple of months in 2020, the markets were still going really well. But as I said, the signs were that we're going to start to enter a period of declining corporate earnings, et cetera. And that's bad for growth. So you needed to reposition in things like treasuries, get a little bit defensive. You could own stuff like gold, the US dollar, and the such like. And so in doing that, what it means is that you're getting rid of the stuff that you've hopefully won on, your winners, right? You're getting rid of that stuff at right about the right time and repositioning out of it and into things that probably weren't winners, but are now about to be, such that you don't experience, as we just described, you don't experience that big drawdown of capital when there's either a crash that comes along or you just are a victim of the part of the cycle where you don't want to have, every single asset class in your portfolio. So this is a very, very important thing as an investor, that you need to understand that investing doesn't mean you buy a stock and own it for 25 years. It means you are willing to change the nature and the composition of your portfolio to suit whatever's going on economically. And there are so many instruments now available, ETFs and global trading platforms that allow investors to do that. There's really no excuse not to do it. And of course, you can buy something like a hedge fund or maybe a diversified fund and try to manage in and out of that. That'd be a little easier for the average punter. But this is not an easy gig by any stretch of the imagination. It is a very, very hard thing to do.
All right. That's it. Well, look, we've come to our time stop, PJ, and I know that you're very upset that we have to.
It's gone so fast.
It's gone so fast. Another 30 minutes is gone, mate. And I've barely got a word in, which is really good because I like listening to what you have to say. So let
me just wrap it up on one key point, because I know we're out of time, and we talked about a lot of stuff today, and there's a lot of more technical things that I talked about. But let me boil it down into just a couple of simple points for your listeners, and that is, right now we are past all of the pain and all of the hardship, and we are entering a period where economies are going to continue to expand. We're going to be getting back to normal. Governments have done the heavy lifting. The reserve banks and the central banks have done a lot of the heavy lifting. So the table is set to have a really serious expansion over the next at least 2 quarters. When we do a show, probably sometime in, let's say, August of next year, I will probably have a different story to tell. But at least from January right through to June, we should be seeing Australia in particular absolutely ripping and doing very well. And I think that'll boil over into the property markets as well, definitely. But certainly the equity markets and growth stocks and value stocks and small caps and things like that will be doing very, very well. So that's what I would like to leave you with today.
Well, there you go. Everyone listening has heard that straight from PJ Patterson at Keystone Financial. PJ giving us the wrap up of the show today, and that it's going to be a very interesting 6 months coming into 2021. So, PJ, thank you very much for that. I appreciate you joining us.
Thank you.
All right, if you want to know how to get a hold of PJ, you can click on any of the details scrolling at the bottom of the screen and enter them into your phone or computer. So you can go to www.zenium.live. No .coms, no .aus, just zenium.live. You hear us up on the website there. You can email us hello@zenium.live. So HELLO@zenium.live. And of course, you can call us on 1300 66 7789. And we are also very open for feedback on this or any of our shows and topic ideas. If there's something you really want to see and be told about, information, things you want to learn about, hit us up, send us an email, and we'd love to put that into a show. And we'll even mention your name if you really want to be famous on our global broadcast. So that is been today's show on Thursday, the 19th of November 2020. And I've been talking to PJ Patterson from Keystone Financial about all things money, finance, and property. And I am your host, Scotty North, and this has been Zenium Live.